One of the most dangerous mistakes in investing is believing that early success proves competence. Markets have a way of rewarding people temporarily and then convincing them that the reward was earned through insight, intelligence, or superior judgment. This illusion is powerful, and it is responsible for more destroyed capital than almost any other error. When people experience a profitable outcome early, they naturally assume causation where there may be none. A rising market, favorable economic conditions, or simple randomness can produce gains that look like skill. The human mind is very good at constructing explanations after the fact. It is far less good at distinguishing between genuine edge and fortunate timing. This confusion is the seed of future losses. The danger does not lie in the initial success. It lies in what follows. Once a person attributes a lucky outcome to skill, behavior changes, position sizes increase, risk tolerance expands. Caution diminishes. The investor begins to extrapolate from a small sample size, assuming that what worked once will continue to work. This is how modest success turns into catastrophic failure. Markets are particularly effective at encouraging this trap because they provide feedback quickly and inconsistently. A good decision can lead to a bad outcome. A bad decision can lead to a good one. Over time, people begin to judge their process by results rather than by logic. This inversion is fatal. Sound investing requires judging decisions by whether they were rational before the outcome was known, not by whether they happened to work. Another layer of this trap is survivorship bias. People see those who succeeded and assume they succeeded because of superior thinking. They do not see the many who used the same approach and failed. The visible winners reinforce the belief that success is repeatable through imitation, when in reality, much of it may have been driven by timing, environment, or luck that cannot be replicated. The longer favorable conditions persist, the more dangerous this trap becomes. Extended periods of rising asset prices create confidence, then overconfidence. Investors begin to believe they have discovered a reliable formula. Leverage increases, risk controls loosen, the margin for error disappears quietly long before the error itself arrives. Eventually, conditions change. They always do. When they do, those who misjudge their own skill are exposed. Losses accelerate because positions are larger, leverage is higher, and emotional attachment is stronger. What could have been a manageable drawdown becomes a permanent impairment of capital. The disciplined investor assumes uncertainty as a default condition. Instead of asking, how smart am I? The better question is, how wrong could I be? This mindset leads to smaller bets, wider margins of safety, and a respect for randomness. It produces slower gains in good times, but survival in bad ones. And survival is not optional. It is the foundation of all compounding. Understanding the role of luck does not mean rejecting skill. It means calibrating confidence properly. True skill expresses itself not in bold predictions, but in consistent decision-making, risk control, and the ability to remain solvent across cycles. The investor who lasts long enough eventually benefits from compounding. The investor who mistakes luck for brilliance eventually exits the game. This trap keeps people broke, not because they are unintelligent, but because they are human. The market exploits this human tendency relentlessly. The antidote is humility, not the superficial kind, but the operational kind that shows up in position sizing, patience, and restraint. In investing, arrogance is expensive, and humility quietly pays dividends over decades. One of the most reliable ways investors destroy long-term wealth is by chasing yield. It usually begins innocently. Interest rates feel low, safe returns seem inadequate. The investor starts to feel that patience is being punished. At that moment, yield becomes emotionally attractive, not rationally justified. High yield almost always signals risk. That risk may be obvious, such as credit risk, or hidden, such as business deterioration, leverage, or structural fragility. The problem is that yield presents itself as income, and income feels safe. People mistake cash flow for security. They focus on what they receive today and ignore what they may lose tomorrow. Many investors convince themselves that a steady stream of income offsets risk. This is a dangerous illusion. If the underlying asset erodes, the income merely disguises the loss until it is too late to exit. By the time the yield disappears, the capital is already impaired. At that point, compounding has been interrupted, often permanently. Yield traps are especially effective because they appeal to logic on the surface. I'm not speculating, people say. I'm investing for income. But income without durability is not investing. It is consumption disguised as prudence. When the principal is at risk, the yield is simply an advance payment on future losses. Another danger of yield chasing is that it often locks investors into fragile structures. High yield products tend to rely on favorable conditions remaining stable, low default rates, continued demand, or uninterrupted cash flows. When conditions change, these structures break quickly. Liquidity disappears, prices fall sharply, and exits become costly or impossible. Yield chasing also distorts capital allocation. Instead of asking where capital can compound most reliably over time, investors ask where capital pays them immediately. This shifts focus from quality to payout, from durability to appearance. The long-term result is predictable, lower total returns and higher risk. In many cases, the real cost of reaching for yield is opportunity cost. Capital tied up in mediocre income investments cannot move into superior opportunities when they arise. Flexibility is lost. Optionality disappears. The investor becomes trapped, collecting small payments while missing large compounding elsewhere. There is also a behavioral element. Income creates emotional attachment. People become reluctant to sell assets that pay them regularly, even when the underlying business deteriorates. The yield becomes a psychological anchor, preventing rational reassessment. This is how small problems turn into large losses. The disciplined approach treats yield as a byproduct, not an objective. The goal is owning assets that grow in value and cash-generating ability over time. If income comes from that growth, it is welcome. If it does not, forcing income usually comes at an unacceptable cost. Long-term wealth is built by avoiding situations where downside overwhelms upside. Yield chasing reverses this equation. It offers limited benefit and unlimited risk. That imbalance is unacceptable. Investors who understand this stay away from seductive payouts and focus instead on resilience, quality, and long-term compounding. This trap keeps people broke quietly. There is rarely a dramatic collapse at first. The damage accumulates slowly, masked by income. Years later, the investor wonders why progress stalled. The answer is simple. Yield was mistaken for safety, and capital paid the price. On the other hand, one of the most subtle ways investors damage their financial future is by committing permanent capital to opportunities that are temporary by nature. These situations often look attractive because they are working right now. Prices are rising, earnings look strong, narratives feel convincing, and the environment appears stable. The mistake is assuming that current conditions will persist long enough to justify long-term commitment. Markets are full of temporary advantages. Commodity cycles turn, interest rate environments shift, regulations change, competitive dynamics evolve, technologies become obsolete. Yet investors routinely behave as if favorable conditions are permanent. They anchor their expectations to the present and extrapolate it far into the future. This is not analysis, it is complacency. Permanent capital requires durable foundations. It demands businesses, assets, or strategies that can survive multiple cycles without requiring constant adjustment. Temporary opportunities, by contrast, depend on narrow conditions remaining intact. When those conditions change, the economics collapse quickly. The problem is not participating in temporary opportunities. The problem is failing to recognize their nature and committing capital as if they were permanent. This trap is especially dangerous because it often appears rational at the time of entry. The data supports the decision. Recent performance confirms it. Peer behavior reinforces it. Everything seems aligned. What is missing is an honest assessment of longevity. How long can this advantage realistically last? What happens when it ends? Most investors never ask these questions with sufficient rigor. Another element of this trap is illiquidity. Temporary opportunities often become illiquid at precisely the wrong moment. When conditions reverse, buyers disappear, prices gap downward. Capital becomes trapped. At that point, the investor is no longer making decisions. The market is making them on their behalf. Permanent capital loses its greatest advantage, the ability to redeploy. Capital flexibility is one of the most underappreciated sources of long-term wealth. The ability to move capital when opportunities arise is more valuable than squeezing incremental returns from fragile positions. When money is locked into structures that depend on temporary conditions, that flexibility is lost. The cost is not just the loss itself, but the missed opportunities that follow. There is also a psychological cost. Investors who commit permanent capital to temporary situations become emotionally invested in the continuation of favorable conditions. They begin defending the position rather than evaluating it. Warning signs are dismissed. Risk is rationalized. The exit becomes increasingly difficult, not because of logic, but because of identity and attachment. Sound capital allocation requires matching the duration of capital to the durability of the opportunity. Short-lived advantages demand cautious sizing, clear exit criteria, and constant reassessment. Long-lived advantages justify patience and permanence. Confusing the two is a structural error, not a tactical one. The market punishes duration mismatches relentlessly. Investors who make them may appear successful for a time, but eventually the mismatch asserts itself. Temporary opportunities fade. Permanent capital absorbs the damage. Compounding is interrupted, sometimes permanently. Those who build lasting wealth are conservative about permanence. They assume that most advantages decay. They demand strong evidence before treating anything as durable. And they remain willing to walk away when conditions change, even if walking away feels uncomfortable. This trap keeps people broke, not because the opportunity was bad, but because the commitment was wrong. Capital must be treated with respect. It should be placed where time works in its favor, not where time quietly turns against it. Most people think a bad financial decision is one that loses money. That is a shallow definition. In serious investing, the most damaging mistakes often make money just not enough to justify the time, risk, and capital they consume. Opportunity cost is the silent force that separates average outcomes from exceptional ones, and ignoring it keeps investors permanently behind. Every dollar you commit to one place is a dollar you cannot commit elsewhere. This is not philosophy, it is arithmetic. Capital is finite. Time is finite. Attention is finite. When you lock money into a mediocre idea, you are not standing still. You are actively choosing not to own something better. That unseen loss compounds quietly over years. The danger of opportunity cost is that it is invisible. There is no red number on the screen, no margin call, no dramatic collapse. The portfolio may even look healthy. Yet compared to what could have been owned, the result is deeply suboptimal. Most investors never calculate this gap, which is why they underestimate its impact. This trap is reinforced by emotional accounting. People evaluate investments in isolation rather than in competition with one another. They ask, is this making money? Instead of asking the far more important question, is this the best use of my capital right now? That second question is uncomfortable because it forces comparison, discipline, and sometimes admitting past mistakes. Opportunity cost becomes devastating when capital is tied up in good enough ideas. Businesses with modest growth, average returns, or limited scalability often feel safe. They produce income. They avoid volatility. They don't create stress. But safety without superiority is a slow leak in long-term compounding. Over decades, small differences in return produce massive differences in outcome. Another version of this trap appears in over-diversification. Spreading capital across too many average ideas dilutes exposure to the truly exceptional ones. Diversification protects against ignorance, but excessive diversification often signals indecision. When everything is owned, nothing is owned in meaningful size. Opportunity cost hides inside this comfort. The most disciplined capital allocators think in relative terms. They are constantly ranking their opportunities. Capital flows toward the highest expected long-term return adjusted for risk, not toward what feels familiar or comfortable. When something better appears, they are willing to reallocate, even if it means selling something that is working. This requires emotional detachment. Humans naturally become attached to positions they have held for a long time. They confuse familiarity with merit. Opportunity cost punishes this bias. Markets do not reward loyalty. They reward accuracy and discipline. Time amplifies this mistake. Early in investing life, opportunity cost feels small because the capital base is small. Later, when the numbers grow, the same percentage mistake becomes life-altering. The tragedy is that habits formed early persist, and by the time capital is meaningful, the discipline is not. Wealth is not built by avoiding losses alone. It is built by consistently placing capital where it can compound the most over long periods. That requires saying no often and decisively to anything that does not clear a high bar. Ignoring opportunity cost is choosing mediocrity by default. The market will not punish you immediately for it. It will simply ensure that you never reach your full financial potential. One of the most expensive illusions in money, business, and investing is the belief that being busy means moving forward. Many people are constantly doing something with their money, trading, tweaking, reallocating, consuming content, analyzing charts, checking accounts, yet their financial position barely improves over years. Activity feels productive. Progress is measurable. Confusing the two keeps people permanently stuck. Markets reward correct positioning, not constant motion. But motion creates dopamine. Clicking buy and sell, watching numbers move, reacting to news, it gives the brain the feeling of control. In reality, most of this activity is noise. It does not improve long-term returns. It often destroys them through fees, taxes, emotional mistakes, and poor timing. This trap is especially dangerous for intelligent people. Smart minds love complexity. They enjoy optimization, analysis, and action. But money does not reward intellectual entertainment. It rewards patience, selectivity, and restraint. Many fortunes were built by doing very little after making a few very right decisions. A common version of this trap is overtrading. People believe that frequent action allows them to capture opportunities. In practice, most trades cancel each other out. Gains are small, losses are magnified, and friction costs accumulate quietly. The portfolio moves, but net worth stagnates. Another version appears in business. Endless meetings, strategy revisions, branding changes, and minor optimizations replace the hard question: is this business model fundamentally capable of compounding capital at a high rate? Busy founders often avoid this question because the answer requires radical change or abandonment of sunk costs. Learning can also become disguised procrastination. Consuming financial content, books, podcasts, and analysis creates the illusion of advancement. Knowledge is valuable only when it leads to decisive, well-timed action and then long periods of inaction. Endless preparation without execution is motion without direction. The market is ruthless in this regard. It does not pay for effort. It does not care how much research you did, how many hours you worked, or how intensely you monitored positions. It pays only for outcomes. And outcomes usually come from a small number of high-quality decisions held for a long time. The most effective investors and capital allocators have an almost boring process. They wait, they observe, they say no, far more often than they say yes. When they act with size and conviction. Then they return to waiting. To outsiders, it looks like inactivity. In reality, it is disciplined focus. Action without clarity is expensive. Progress requires a clear standard. What am I trying to achieve? What metric actually matters? If an activity does not move that metric meaningfully over time, it is distraction, no matter how sophisticated it feels. People stay broke not because they do nothing, but because they do too many low-impact things. Wealth grows when energy is concentrated, not scattered. If your financial life feels busy but unchanged, the problem is not lack of effort, it is misplaced effort. Now, most people think the goal of investing and business is to make money fast. That belief alone keeps them poor longer than almost anything else. The real game is survival first, growth second. People who chase high returns expose themselves to fragility. They take leverage they don't fully understand. They concentrate capital in trendy assets. They underestimate downside because upside is emotionally louder. One bad cycle wipes out years, sometimes decades of effort. Avoiding ruin is not exciting. It doesn't feel ambitious, but it is the foundation of every long-lasting fortune. The difference between someone who compounds for 30 years and someone who keeps restarting at zero is rarely intelligence. It is exposure to irreversible loss. Losses are not symmetrical. Losing 50% requires a 100% gain just to break even. Losing 80% requires a 400% recovery. Many never recover at all because capital is not just financial, it's psychological. Big losses destroy confidence, patience, and discipline. This is why reckless strategies attract beginners. They advertise upside, not survivability. They show charts of massive gains and hide the bodies of those who were wiped out. Survivorship bias turns gambling into strategy. Smart capital behaves defensively. It assumes things will go wrong, not because of pessimism, but because reality is unpredictable. Markets change, businesses fail, regulations shift, technologies become obsolete. Black swans do not ask permission. The people who last build margins of safety everywhere. They avoid excessive debt. They don't bet their future on one outcome. They prefer durability over speed. They accept slower gains in exchange for staying in the game. This applies beyond investing. In business, overexpansion kills more companies than lack of ambition. Hiring too fast, scaling before product market fit, or chasing growth metrics without cash flow turns success into collapse. In personal finance, lifestyle inflation is another form of ruin risk. People upgrade expenses as soon as income rises, leaving no buffer. One setback, illness, job loss, market downturn pushes them backward years. The obsession with maximizing returns blinds people to the most important question. What could permanently take me out of the game? Wealth compounds when mistakes are survivable. It collapses when they are not. The irony is that by focusing on not losing, people often end up winning more over time. Consistent, modest gains held through decades outperform dramatic wins, followed by catastrophic losses. The market does not reward bravery. It rewards endurance. If you are still here after everyone else blew up, time does the rest of the work for you. Another trap I want to mention is confusing safe with low risk. This trap destroys wealth quietly, politely, and over decades, which is why intelligent people fall into it more than reckless ones. They believe that avoiding volatility means avoiding risk. It doesn't. What feels safe in the short term often becomes dangerous in the long term. Holding cash endlessly feels responsible. Keeping money in low-yield savings feels conservative. Avoiding discomfort feels prudent. But inflation is not passive. It works every day, whether you acknowledge it or not. The purchasing power of money erodes silently. No headlines, no panic, just slow decay. People underestimate this because inflation doesn't create emotional pain the way market crashes do. There is no sharp loss, just a quiet shrinking of future options. A person who avoids all volatility often accepts guaranteed loss instead. True risk is not movement. True risk is permanent impairment of purchasing power. Many people say they are playing it safe while locking themselves into outcomes where their money earns less than inflation, their skills stagnate, their income stays fixed while costs rise, their optionality shrinks year after year. That is not safety. That is slow suffocation. Real safety comes from adaptability, not stillness. Capital that compounds modestly beats capital that sleeps. Skills that evolve protect income better than job titles. Businesses that reinvest intelligently survive longer than those that merely preserve. The same misunderstanding appears in careers. People stay in roles they dislike because they feel secure. Years pass, skills become obsolete. When disruption arrives, they are less employable than they were before, despite years of stability. The illusion of safety delays action until options disappear. Markets reward people who understand the difference between volatility and risk. Volatility is noise. Risk is loss of long-term viability. You do not need reckless exposure. You need intelligent exposure assets, businesses, and skills that grow faster than decay. Playing it too safe is often just fear dressed up as wisdom, and fear compounds negatively. Those who build wealth learn to tolerate short-term discomfort in exchange for long-term resilience. They accept fluctuations. They think in decades. They protect downside without freezing themselves in place. Stagnation is not protection. It is vulnerability that unfolds slowly enough to be mistaken for comfort. I want also to briefly talk about misaligned incentives. Most investors assume that the people offering advice, selling products, or managing capital are working for their best interest. That assumption is deadly. Misaligned incentives quietly extract value from your capital without ever appearing as a loss at first. Every product, every service, every manager, every platform has someone who benefits more than you. Wall Street is full of strategies designed to generate fees, not returns. Mutual funds, structured notes, brokerage platforms, even some advisors profit whether you win or lose, sometimes more if you lose. This trap is subtle because it looks like alignment. Advisors speak your language, charts justify moves, glossy reports suggest intelligence. But alignment is superficial. Look behind the incentives. Who earns if this succeeds? Who earns if it fails? You must always invert the question. The problem is compounded by human psychology. We trust authority figures. We defer to expertise. We assume that if a product is popular, it is safe. Misaligned incentives exploit this bias. People end up paying for safety they do not have, returns they cannot keep, and advice that serves someone else's compounding more than their own. Many investors blame themselves when these situations fail. They think, I should have understood the product better, or I misjudged the timing. But the deeper failure is structural. The game was designed against them from the start. Ignoring incentives is like swimming in a river without knowing the current. You may move, but you will drift where someone else chooses. Long-term wealth demands vigilance. Every decision should pass the incentive test. Ask, who benefits most from this arrangement? And is my upside aligned with theirs? Small misalignments compound over time. Fees, hidden costs, and behavioral nudges quietly erode performance until decades of capital are impaired. Those who succeed recognize that the most dangerous trap is invisible. It comes in the form of structures, contracts, and advice that look neutral but are anything but. They survive not because they are brilliant, but because they refuse to participate in arrangements where the incentives are stacked against them. Misaligned incentives are the silent tax on wealth creation. Ignore them, and no amount of intelligence, patience, or discipline will protect you. Recognize them, and you remove a key obstacle that destroys more fortunes than bad luck, bad judgment, or market volatility combined. I want also to mention something very important. Many investors and business people fall into the trap of thinking they can predict the future with precision. They believe patterns repeat exactly, that past data perfectly informs the next move, or that their judgment is superior to the collective market. This overconfidence is a silent killer of capital. Markets are complex systems. Variables interact in ways that are often nonlinear, chaotic, and unpredictable. Trying to forecast outcomes with certainty is an act of hubris. The more confident someone is about a prediction, the more likely they are to take on hidden risks, concentrate positions, or ignore warning signs. This trap often begins subtly. A small, early success, a correct prediction, a fortunate timing, a profitable trade convinces the investor they have discovered a replicable formula. The next decision is made with more conviction and more capital. The illusion grows. The edge they think they have is often just luck amplified by selective memory. Overconfidence has multiple costs. First, it leads to risk concentration. Believing strongly in a forecast, investors place disproportionate bets on a single outcome. Second, it reduces humility. Warnings from other sources are ignored. The possibility of error is discounted. Third, it fosters impatience. People stop waiting for superior opportunities because they think they can time the market repeatedly. Even professional investors are not immune. Analysts create precise models, CEOs present forecasts, economists release projections, all treated as near certainties by those consuming the information. The market rewards humility and punishes hubris. When the forecast is wrong, losses compound faster than expected because of leverage, conviction, and overextension. A key part of avoiding this trap is inversion thinking. Instead of asking what will happen, ask what could go wrong. Instead of assuming certainty, model a range of outcomes, especially low probability but high impact events. Prepare for scenarios, but never bet on one specific future as though it is inevitable. This trap also affects timing. Investors overconfident in their predictions often enter or exit positions too early or too late. They confuse control with influence. They treat probability as destiny. Markets remind them of reality with harsh efficiency. The human mind loves stories, and overconfidence exploits this bias. A coherent narrative feels correct. Investors sell themselves on continuity where none exists. They forget that history is full of cycles, reversals, and surprises. The market does not care for coherence. It obeys mechanics, incentives, and randomness. Wealth preservation requires humility about the future. It requires treating forecasts as tools for planning, not as commands to act. The disciplined investor sizes positions conservatively, maintains optionality, and respects the unpredictability of complex systems. Overconfidence in forecasting is dangerous because it combines illusion with action. It is not enough to be wrong. The act of betting on being right multiplies the harm. Many investors fail not because they lack intelligence, but because they overestimate the certainty of their own insight. Recognizing the limits of prediction is a profound advantage. It prevents catastrophic mistakes, preserves capital, and allows flexibility when surprises inevitably arrive. The patient, humble, and observant investor wins quietly, while the overconfident chase headlines and ephemeral trends. So, yes, let's move to excessive leverage. Leverage is seductive. It promises magnified returns without the need for additional skill. It looks like a shortcut to wealth. But leverage is a double-edged sword. What magnifies gains also magnifies losses, often far beyond what the investor anticipates. Excessive leverage is responsible for more ruin than poor judgment, market timing, or even bad luck. The problem is not leverage itself. The problem is using it without full appreciation of volatility, liquidity, and margin for error. Leverage amplifies everything: outcomes, emotions, and mistakes. People become overconfident when they leverage. Small wins reinforce the illusion of control. They begin to believe they have discovered a formula or edge, while in reality, they are simply riding volatility. A single adverse event can wipe out years of gains, leaving capital impaired permanently. Another danger is psychological. Leverage increases stress, emotional reactivity, and the temptation to react impulsively. Investors begin micromanaging positions, chasing losses, or doubling down in fear. What seemed like a calculated strategy becomes a behavioral trap. Excessive leverage also hides structural fragility. Companies, funds, or individuals may appear profitable and stable under normal conditions. Introduce a small shock, a rise in interest rates, a market dip, or operational hiccup, and solvency disappears almost instantly. What felt safe is revealed as precarious. The antidote is discipline. Leverage, when used at all, must be modest, fully understood, and paired with sufficient capital to survive multiple cycles. Professionals often treat leverage as optional, not necessary. They use it to enhance, not replace, skill. They plan for scenarios where markets behave poorly. A key lesson is that capital is far more precious than ego. Risking large amounts on the promise of accelerated growth is vanity, not strategy. Markets punish vanity. Time compounds humility. Survival compounds wealth. Excessive leverage also magnifies opportunity cost. When capital is tied up in leveraged positions, flexibility disappears. A better opportunity arises, but the investor cannot redeploy. By the time leverage is unwound, the superior chance has passed. The history of finance is littered with examples. Firms wiped out, fortunes evaporated, careers ended, all because leverage was misunderstood. The pattern is consistent across decades and geographies. Every time, the logic is seductive, the risk underestimated, the pain delayed. Ultimately, the disciplined investor treats leverage as a tool, not a shortcut. They respect volatility, anticipate error, and maintain margins of safety. They understand that compounding is far more valuable than momentary magnification. Excessive leverage is the trap that feels like progress but contains hidden destruction. Avoid it relentlessly. Your future compounding depends on your restraint today.